Between market volatility and shifting supply chains, a single funding round for a commodity trading tool signals more than just startup optimism. Pillar raised $20 million to accelerate a platform that promises faster pricing, smarter risk controls, and tighter capital efficiency for traders who move copper, crude, and agricultural grains every day. In a world where a 3% swing in a barrel price can redraw balance sheets, investors are watching tools that promise transparency and speed. This moment matters because it blends fintech gravity with real-world commodity dynamics, influencing hedges, liquidity, and strategic bets worldwide for traders and allocators alike. Pillar is backing a software tool designed to streamline how commodity traders price risk and execute deals. The capital infusion will fund product development, data connections, and security measures that surface real-time price correlations, inventory signals, and margin requirements. Think of a trading desk amplified by cloud-based analytics, dashboards that flag unusual moves, alerts when transport routes tighten, and automated order routing that seeks best execution. In plain terms, this is not a fund, but a platform that helps buyers and sellers agree on value faster while reducing guesswork in volatile markets. It translates complex data into actionable signals for traders' everyday use. Commodity trading has always mixed science and nerves. From the post-war exchange growth to the rise of algorithmic desks, firms chased faster data, better connectivity, and tighter risk controls. Pillar enters a crowded field where banks, hedge funds, and independent traders deploy analytics layered over futures and options. The tool concept echoes earlier platforms that bundled price feeds, risk models, and trading signals, but the current generation leverages machine learning, cross-asset correlations, and real-time weather or shipping data. A 20 million round signals validation that investors expect practical, scalable technology to reallocate stakes efficiently. The arc mirrors fintech tides. Markets are watching the pillar move as a gauge of software-driven efficiency. Traders are already reporting tighter bid-ask spreads in volatile sessions as platforms promise faster price discovery and lower latency. In commodities like copper and oil, even modest improvements in execution speed can trim millions in daily trading costs. Bank desks and prop shops are quietly testing integrated tools, while exchange operators highlight growing demand for robust data feeds and compliant automation. If funds view this as infrastructure, capital can flow toward more predictable hedges, potentially smoothing dislocations during supply shocks. Analysts cite structural shifts toward data-driven workflow. Everyone from commodity traders to asset managers stands to gain or lose. Producers like miners and refiners could benefit if tool-aided hedging across cycles, reducing cash flow volatility. End users such as manufacturers face steadier inputs when price discovery is more transparent. Exchange operators, data vendors, and cybersecurity firms may see revenue growth as demand for feeds, latency, and protection climbs. Retail investors could access simplified dashboards, while family offices and sovereign funds reassess allocations toward diversified commodity exposure. The story touches banks, brokers, and fintechs who build the ecosystem around faster, safer trading. Policymakers may monitor concentration and risk geopolitics, and macro trends frame this funding moment. Ongoing supply disruptions, sanctions, and trade routes reshape risk premiums in oil, metals, and grains. Central banks, tightening or easing policy affects liquidity and carry trades that power futures markets. Currency swings and inflation reshape hedging costs of producers and buyers alike. The pillar round arrives as agencies project growth in digital infrastructure spending and data-driven finance, aligning with broader shifts toward transparency and resilience. In short, capital is chasing tools that convert opacity into actionable, scalable coverage against macro shocks. Geoeconomic blocks influence cross-border flows and risk pricing decisions. Smart money is testing the premise that better software reduces friction and surprise. Large asset managers are partnering with fintechs to pilot pilots that connect risk models to live markets, while some funds tighten exposure to stickier inflation bets and raw material equities. Retail brokers report rising interest in accessible commodity dashboards and simple hedges as investors seek insulation from volatile headlines. Monetary signals, premium yields, and performance fees shape how capital flows. Still, many institutions demand rigorous governance, audit trails, and regulatory clarity before deploying substantial capital into new trading tools. Analysts caution that hype must meet how disciplined risk controls. Every investment has a caveat if the software claim outruns implementation. Pillar could face cybersecurity risks, data feed outages, or over-reliance on back-tested signals that crumble in live markets. If pricing models misread supply shocks, losses may accelerate rather than hedge. Vendors may overpromise scale while integrations lag with legacy systems, creating operational risk. Concentration risk is another worry when a single platform becomes indispensable. Regulatory scrutiny on algorithmic trading and data privacy could raise compliance costs. In markets, perception can outrun reality, and a few bad weeks can erode confidence quickly. Investors may rotate into safer hedges during turbulence. For retail participants, the lesson is to anchor decisions in risk budgets rather than hype. Start with clear limits on exposure to commodity-linked tools and avoid chasing top-performing dashboards without governance. Use slow-tested strategies like diversified baskets, simple hedges, and small positions that you can review weekly. Seek products with transparent fee structures, independent audits, and clear data sources. Compare platform uptime, customer support, and regulatory compliance. If a composite tool becomes essential, build a personal backup plan and maintain liquidity to weather drawdowns without panic selling. Start with demo accounts and document everything. Only invest what you can afford to lose. Looking ahead, Pillar's funding signals a broader push to digitize commodity markets without sacrificing discipline. If platforms prove durable, expect faster cross-border trades, tighter risk controls, and better alignment of price discovery with physical pressures from storms and seasonal demand. Public markets could see greater participation from smaller traders who once faced barriers to entry. Regulators will test data security and fair access, while incumbents evaluate partnerships over pivots. Industry watchers anticipate a measured path for scalability, governance, and practical usefulness before broad adoption. If you have found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.